Right then. So let me erase this one so that we can do the question. Right, so first we'll do the capital treatment. So capital treatment or capital approach. Right, so in capital approach we do it normally. So we'll take the sales proceeds less the cost, so whatever it is on which that will be the amount. Then we'll have to deduct any capital allowance if there is any or anything else. Right, so 1500 shares has been sold, 1500 shares has been bought back by the from Victoria, and the value is £30 each. So we'll have to take sales proceeds you know, 1500 shares at the rate of £30 each, and that is going to be 1500 into 30, £45,000 is the sales proceeds. Right then, and now we need to deduct the cost out of that. So let's see the cost in the question. It says Brownie paid 16,500 for the shares on 1st of February 2014. However, the probate value when the shares were inherited by Victoria, the probate value by the court is £16,000 on 1st of February 2016. So we'll take the probate value in the cost. Right. So the probate value, just write down in the note. Sorry, in the brackets. So the probate value is 16,000. Yeah, on 1st of February. So £16,000 will be deducted out of that. So let's see what's the difference. £45,000 less 16,000. £29,000 is the difference. Now after that we need to deduct the annual allowance out of that. However, before deducting the annual allowance, Victoria has got capital losses carried forward, so and they are of 3,300. So we'll deduct the capital losses brought forward. So capital losses brought forward, and these are 3,300. So these will be deducted first. £29,000 less 3,300, 25,700. Right, now we need to deduct the annual allowance or annual exemption. Sorry, not an annual allowance, annual exemption of capital gains tax. Right, and it's 11,100. So 25,700 less 11,100. That's 14,600. Right, now on that we have to pay the capital gains tax. Now there are different rates of capital gains tax, as you know, from 10%, 20% if it is residential property, 18% and 28%, and there's something called entrepreneur relief as well. Now we'll have to see and figure out if the entrepreneur relief is available. If entrepreneur relief is available, then the tax rate on this chargeable gain will be 10%. Right, so let's see in the question. Now one of the conditions of entrepreneur relief, if you remember from your notes, or actually let me tell you the page number as well so that you can see the notes as well. Just bear me 1 second, let me see in the notes. If you could check on page number 47 of your lecture notes, page number 47 of your lecture notes, entrepreneur relief. It says entrepreneur relief is available on the gains of the following. Now if you look at the number 3 here in the list, it says disposal of share in a personal company. A personal company means 5% or more than that. So Victoria has got 5% shares in the company. So if you hold 5% or more in the company, and the individual is an officer or an employee of the company. She's an employee of the company as well. And then it says the company must be a trading company. This is a trading company, we know that. Shares disposed must be owned at least 1 year before disposal. Now, shares minimum ownership of 1 year is also met. So all of the conditions of entrepreneur relief are fulfilled. So we'll charge tax at the rate of 10%. So capital gains tax. Capital gains tax is going to be at the rate of 10%. Entrepreneur relief. Right? That is 1460. Now in the question it is asking about after tax proceeds. Now after tax proceeds means that we'll take the sales proceeds and we'll deduct the tax out of that. So whatever the difference is, that is called after tax proceeds. So difference between this and the tax amount, so £45,000 less 1460, 43,540. It is after tax proceeds. That's what the question was asking about, after tax proceeds, and it is 43,540. Right? That is under the capital approach. Now if we use the income approach as well, in the question it asks for income approach too. So if we take the income approach, now if you take the income approach, we'll take the sales proceeds, and in the sales proceeds 1,500 shares, and at the rate of £30 each, and it is going to be exactly the same amount, which is £45,000. Right? Now we need to deduct the cost out of that. Now cost under the income approach, if you remember, is the original subscription price. Whatever the original subscription price is, cost is that under the income approach. Now in the question it says £2 per share, so it will be £2 per share, which is the original subscription price. So 1,500 into 2, this is £3,000 is the cost. If we deduct this one out of that, £45,000 less £3,000, it's so obvious, £42,000. Right? Now this is the amount which is taxable, and because it is an income approach, so it will be considered as dividends. Now dividends up to £5,000, it is at the rate of 0% because it is under the dividend nil rate band, and on excess of that it will be according to the tax rates. However, in the question, if you read the question carefully under the Victoria, it said to us that Victoria has got £40,000 of income, taxable income of £40,000, including dividend income of £6,000. Excuse me. Now when it said including £6,000 dividend income, it means that she already got the dividend income of £6,000, which means that she has already used the dividend nil rate band as well. So she has already used the dividend nil rate band, so this amount is going to be taxed at the rate of 32.5%, and whatever the tax amount is, so £42,000 multiplied by 32.5%, that's 13,650. So that is the amount of tax on the dividends under the income approach. Right? Now another thing as well, if we consider the capital gains tax for under the income approach, because there are two things under the income approach. One is the income tax, another one is capital gains tax as well. Now if you see the capital gains tax under the income approach, proceeds, if you remember, proceeds will be the original subscription price, which is £3,000, whereas cost is going to be exactly this amount, which is probate value, and it is going to be £16,000. Now under this category, it will be a capital loss of £13,000. That is capital loss. Right? If we use the income approach, a capital loss will be £13,000, and tax is going to be 13,650. And again, for dividend income as well, you can again calculate the difference between the proceeds and the tax. So the net amount, whatever it is going to be after tax proceeds 31,350. So these are after tax proceeds. That's what the question was asking, after tax proceeds. So we have been given this, right? All right then, so let's move to the question again, and let's do the other part as well. So in the part C, it says explain with supporting calculations where necessary the tax implications of the purchase and loan of the motorcycle for both Melba and Trifles. So let's see which information is he talking about. He's talking about motorcycle. A motorcycle will be purchased by Trifles Limited on for £9,000 on 1st of April 2018. Will be made available on loan to Melba for the whole of the tax year 2018-19. Melba will pay Trifles Limited £30 per month for the use of the motorcycle. Right. So basically, motorcycle was given to a shareholder, and its value was £9,000, and some amount was being paid for the use of that motorcycle as well. All right. Now you want us to calculate the benefit for that, if there is any taxable benefit, if it will be considered as employment income, or because it is a closed company, or it is any other different treatment for that. All right. So what we need to do is, because it is a loan, it is a motorcycle provided to a shareholder, because this shareholder is no longer an employee of the company. It was a director, Melba was the director, but Melba is no longer a director of Trifles Limited. So this is a motorcycle given to a shareholder who is not an employee of the company, no longer an employee of the company. So what would happen is, we'll take the normal benefit, whatever the normal benefit will be under the normal rules, and that amount will be considered as distribution or dividend given to a shareholder. All right. So what was the amount of the what is the price? Price is £9,000 of the motorcycle. So that is the value of motorcycle, value of bike, you can say, of motorcycle. That is £9,000, right? Now the normal the way to calculate the benefit of motorcycle is at the rate of 20%. So 20% of £9,000 is going to be £1,800. Now out of that, some amount will be deducted, which is being contributed. Melba will pay Trifles £30 per month for the use of the motorcycle. So £30 per month means 12 times 3, 360. 360 will be the contribution. So less 360 will be deducted out of that. So it will be 1440, if I'm not wrong, 1440. Yep. So 1440 will be the benefit of the motorcycle, and this is the amount. This is the amount which will be considered as distribution or dividends, and Melba will have to pay tax on that, and the tax rate will be 32.5% on that. 32.5% will be the tax rate. So whatever the amount is, please make sure you calculate it. Whatever the amount, it will be considered as distribution, as tax on distribution or tax on dividend. So it's done. Let's do the other requirement as well, which in part B says explain the supporting calculation where necessary tax implications of the loan for both TOT and Trifles Limited. So if any loan is given, here is the information. TOT acquired a holding of 3,400 shares in Trifles Limited when it was incorporated, has taxable income of £40,000, including dividends of £6,000 in 2016, 17, 18, 19 and 20. Excuse me. On the next page, cash loan, Trifles Limited will loan £50,000 on 1st of April 2018 with interest payable at the rate of 3%. Now one thing is clear, that because official rate of interest of 3% is being paid, which means that it will not be a beneficial loan, right? And then it says 20,000 pounds will be paid back, and remainder of the loan will be outstanding thereafter for the foreseeable future. Now 50,000 pounds worth of loan was given, and although official rate of interest is being paid, but it is a closed company, right? So whenever in the closed company, if any amount of loan is given to a shareholder, then what would happen is the company will have to pay a penalty to HMRC at the rate of 32.5%, right? Now company will have to pay a penalty on the 50,000 pounds. 32.5% of that will be paid to HMRC. Let me grab my calculator and let's see how much it is. So the amount of loan was 50,000 pounds, and on that we'll have to company will have to pay tax at the rate of 32.5%. So 50,000, basically 3250 divided by 2 is going to be the amount 1625. Is it 1625? Sorry, 16,250. Yep, 16,250. Right, so this is the amount which will be given to HMRC as a penalty because the loan was given to a shareholder. Now, when the part of the loan or whole of the loan is given back to the company by the shareholder, by the borrower, then we will contact HMRC, and the penalty or part of the penalty will be paid back to us as a company. So because 20,000 pounds worth of loan was paid back, so we'll contact HMRC, and HMRC will say, all right, okay, your penalty was 16,250, and the total amount of loan was 50,000 pounds. Out of that, 20,000 pounds is being paid, so that is the amount which we will pay you back. So 16,250 multiplied by 20,000 pounds of the loan is given back out of total of 50,000 pounds. 6,500 pounds worth of loan is paid back, and 6,500 pound of the penalty will be paid back to the company by HMRC. Now remaining penalty could also be paid back to the company if the shareholder gives the remaining loan back to the company, or if the shareholder is not giving, then if the company writes off that loan, and when it writes off that loan, it will be assumed that the shareholder has been given dividends. In that case as well, the company will, HMRC will give you back the remaining amount of the loan, remaining amount of the penalty which you have paid. All right. So that's it for this video, and I will see you in the next video, and then we will continue with our ACCP 6 taxation. Thank you very much, and goodbye.